Welcome to Brickflow's October Industry Insights. For those that haven't seen it before, it's a monthly roundup of the common trends and conversations we're having with commercial finance brokers, property entrepreneurs, property agents and lenders. The aim of this video is to give you the inside track of what is happening in the markets and put you in touch with the current market sentiment. After a tumultuous 7 weeks of government and economic upheaval, this month we assess the effects that this has had on the commercial property and finance markets. This month we'll firstly focus on development finance. So the good news is that with development finance it's pretty much business as usual at the moment. Pricing has obviously increased, creating huge variances between lenders now. So brokers and borrowers need better market information to avoid costly mistakes. However, leverage has hardly changed and everyone is still lending, albeit perhaps being a bit more choosy over the projects and borrowers they support. As we said before, property development is counter-cyclical. If you're buying land to build new homes on at the moment, then you're around 2 years away from delivering those properties to market. And that's if you have your planning already. If you need to go through the planning process, then that could easily become 3 years. Therefore, what house prices do in the next 12 months or so is less of a concern. Property developers instead want to know what prices will be doing in 2 or 3 years' time instead. Everyone will have their own view on interest rates and the effect that will have on the market. The consensus now seems to be that they won't increase by as much as previously forecast and that any rise will be fairly short term. High enough to get our stubborn inflation under control, but short enough not to cause a property market collapse through unsustainable mortgage costs. This theory is part supported by swap rates. The 2-year swap rate is currently higher than the 5-year swap rate, which means the markets feel that interest rates will be lower on average over the next 5 years than they will be on average over the next 2 years. So that's good news. With 2024 being an election year, assuming of course we hang on that long, you would think the government will be doing all it can to ensure that the end of 2023 and the beginning of 2024 will be looking a lot more positive than where we are at the moment. Whilst rate setting is independent, government policy is a huge arbiter of interest rate setting, and you can expect policy to be shaped with that end goal of a more vibrant economy and a decreasing rate outlook come election time in 2024. What has been most interesting about recent events is the effect it has had on the pricing of loan products. In the development finance market, you can borrow from banks and also from what we call non-banks. Loans from banks are typically pegged to an index like the Bank of England base rate or SONIA, which is previously LIBOR. Therefore, the cost of borrowing from banks at the moment has increased and will increase much further as interest rates push higher. Within the non-bank category of lenders, you have various different types of funding sources and structures. Some offer floating rates and have equally been affected as the banks, but most importantly, and unlike with banks, there is still some fixed rate money available with non-bank lenders. So how are these non-bank lenders funded? Well, perhaps counterintuitively to some people watching this, some non-bank lenders are actually funded by banks. Figure that out. So their funding costs have behaved in exactly the same way. If they're tracking an index, then their cost of funding has also increased. However, some non-banks are funded by other institutional funding lines, perhaps a pension fund or an insurance company. There is not a uniform way in which these funding lines are priced. Therefore, some will be strongly correlated to an index such as base rate or SONIA, others will not. It's those that are not pegged to an index that could deliver best value to borrowers and brokers right now. Other non-bank lenders are funded by peer-to-peer money. There aren't many lenders that I can think of that are still purely funded by this source of capital, as most will have alternative arrangements in addition. But it will be interesting to see how resilient the retail investor money is to increasing interest rates. The biggest driver for investors within the P2P sector has always been the attraction of the higher returns that could be achieved in comparison to their money sitting with their bank, for instance. But if interest rates rise and retail investors can earn 5% in a 30-day notice account, will they still be seduced by a 6% return on a permitted development scheme to a novice developer? Regardless of how you have sourced your funding before, it is now more important than ever for brokers and borrowers to be shopping around. Only going back to the same lender at the moment is bordering on reckless. If your normal lender's sources of capitals have been unduly affected by the recent turbulence, then that lender, who's always looked well priced, can now be very expensive. And whilst they might tell you that everyone has been affected in the same way, they definitely haven't. As one very experienced development finance broker that uses the Brickflow software remarked to me last week, 12 months ago, I would have known with a very high degree of certainty what every one of the 40 lenders on Brickflow would be pricing out and what their lending appetite was. But today, I have no idea. Excuse me. As I said at the start, there's been little change in appetite and leverage. And that is primarily due to there being a lot of liquidity in the market. There's currently no evidence to suggest that development finance will dry up like it did in the aftermath of 2008. So the two biggest barriers to property developers at the moment building more stock seem to be high land prices and the planning process. Land prices are beginning to fall but still have a considerable way to go. As rates increases and more full sellers come to market next year, there will of course be discounts to be had. The planning process, however, is a mess and needs wholesale review and structural change to make it fit for purpose. One can only hope that our new political leadership can take the radical steps needed rather than applying the recent sticking plasters of stamp duty amnesties and permitted development reform. I hope that was useful, and remember to check out part 2 of the industry insights that will be posted very soon.